Welcome to Retirement Talk. I'm John Maxon here with Pete Benson. We're the show that gives you wealth strategies that actually work. And today we're going to be talking about a really important topic. We're going to talk about some of the biggest mistakes that people make with their investments in volatile markets, especially when they get concerned, Pete. The first one is you can actually play it too safe with your money.
Yeah, you actually can. Hiding it under the mattress, putting it in your sock drawer, you're not going to make anything. And so you have to be making something on your money. And I understand when things get tough, it's easy to bail. It's easy to just say, hey, I'd rather just not lose anything, and I'm willing not to make anything. But you know, when you do that over a long period of time, you're really losing an opportunity to keep up with inflation. And inflation's been low for many, many years, but there's also times that it rises pretty high. And at the time of this taping, this is one of those times. It's going up pretty high, so you've got to be careful that you don't just play it too safe. And John, the good thing is there are ways to play it safe, but at least get some return on your money, and hopefully even keep up with inflation.
Yeah, I mean, the truth is we haven't had inflation like this since the 80s, 40-year high. And it was supposed to be just kind of transition, right? It's going to be a few months. That's what the government officials said. Well, it doesn't feel like it's just a few months when you go to the pump and you fill your car up. I've got two teenage boys. One is 11 years old. He kind of acts like a teenager. When we go to the grocery store, that doesn't feel like inflation's just kind of just sitting there. And you know, Pete, with life expectancies, people are living longer, not necessarily better. Yeah. So if you live 25 or 30 years in retirement, you want your money certainly to be conservative. Having some money that's safe is important, but you got to have some growth components of that too, because you can actually retire and go broke safely.
Yeah, and here's another thing. Not everyone that's watching this is retired.
Right.
You know, you may be in your 20s, 30s, 40s, 50s. Time is on your side. You're investing for growth. And what we see a lot of times is people that are 35 years old have a 401k, and they're invested like they were 65 years old. They've got all kinds of bonds and cash and stable value fund and so on because they're scared because the market's going down. Well, guess what? This money's for 30 years from now. So don't play it too safe even in your working years either. And then there's another one, John, failing to diversify. We see that all the time.
All the time. Like the hot stock of the month, right? Like last year, everybody was talking about Tesla. We're still talking about Tesla, like every day, right? But if you look at Tesla at the time we're doing this, it's down on the year. And, you know, Elon Musk has gotten himself into some trouble with Twitter and all that kind of stuff. But I guess if you can write a check for $44 billion, and he's probably still going to make his mortgage payment.
Yeah, probably.
So
probably doesn't have a mortgage payment.
Yeah, probably not. But the bottom line is, you know, you're sitting around having coffee with your friends or maybe a glass of wine, and they're talking about that hot stock that, you know, they've made all kinds of money. And usually people get in, not always, but at the wrong time. It's like when everyone else has already gotten a return, then you buy that stock, you put more money there, you fail to diversify, then you really should have there right before the market corrects or that stock corrects or something like that. So having money that is diversified, portfolio studies show over decades of research that diversification has a huge role in your overall positive return over time.
Yeah, absolutely. It's like betting on one horse. I mean, that horse, if he's going along really good and wins a lot of races, you feel really good. But if he gets a broken leg or something, down you go. And that's how quickly things can happen with just a bad press article or something like this. Yep. So you've got to diversify, because what's high this year may be very low next year on the good opportunities. So having yourself spread out there, really good idea. And then, John, borrowing to invest. We get this occasionally. People will say, well, you know, what about if I borrowed this money? I can get it really inexpensive. Maybe it cost me 2 or 3%. I might make 6 or 8%. Yep. The key word is might.
Yeah, and we've seen this in the real estate market. When the real estate market was up at an all-time high, people took equity out of their house to put more money into the real estate market because it was always going to go up. Now those equity lines are on floating rates. The Fed's been raising interest rates, and those payments continue to go up with the economy slowing down. Or how about margin? Yeah. A lot of people, you know, recently, it's been a while, probably 4 or 5 months, margin or borrowing money from brokerage houses to buy stocks was at an all-time high. Well, when the market corrects and goes down, you get what's called a margin call. And in order to satisfy those margin calls, you actually have to sell the stock to pay that margin off. And so borrowing to invest best. It probably works for some people, but I would say in the law of averages or probabilities, it's probably not the most sound investment advice. And probably the thing, Pete, that we see in today's economy and market more than anything is people that get nervous or they get scared. They turn their TV on, you know, regardless of what their political affiliation is. The media is not your friend, and they're all biased in our opinion, and they get scared into making really bad decisions on their investments, and they bail when the market's low or volatile.
Well, and these headlines out there, well, this is different this time. This is unprecedented and all that. It's not that different than all the other time. They say that every single time as a way to create fear, and that's what sells. And then what you do is you sell because of believing that. It's like these scams that are out there. You're believing what they're saying and reacting to that. People who aren't even in the financial business, they're in the journalism business, if you can even call it that sometimes. They're in the fearmonger business, and so you bet against the future and you bail, and it was the wrong time to bail. And so again, these are costly mistakes that you need to avoid.
Yeah, or they've got like a $39 newsletter.
Yeah, all
if
the
you
time.
buy their $39, or probably my favorite commercial out there is there's this guy. He's kind of famous. I can't remember his name, but he's sitting on a horseback. It's like he could be on a horse in a ranch out in Leapers Fork. And he's talking about how he puts all his money in gold.
Oh, yes.
Now, I'm sure that they're not paying him anything to say on that horse that he's probably never been on a horse in his life.
Probably doesn't even have any
right?
gold.
And no, he probably doesn't. But I'm sure he's being paid nothing to tell you to put your money in gold. So I guess my opinion about that is if we get to the point where we're bartering on the street corners with gold coins, the social unrest, you better have a fast horse because it would probably be pretty bad. Well, thanks for watching the show, folks. We hope we added some value. Make sure you subscribe to our channel for our latest episodes. And thanks a lot. We appreciate you tuning in.